The following is a presentation of TFNN. It is now time for the Tiger Technician Hour with your host, Basil Chapman.
Hi everyone, Basil Chapman, June the 25th, and Tiger Technicians Hour. My pleasure to be here Monday, Wednesday, Friday at this time, 11 o'clock till noon Eastern. And thank you, Steve, for 2 great hours. Tom's away. I will be doing Tom's show tomorrow evening. Yep, the last hour tomorrow evening. Looking forward to that. No, is that right? Yep, the 26th. And that'll be my pleasure. So let's run the numbers. This is a very important period, and I'll explain exactly why I'm looking at this as an important period. And we can talk about it as 3 letters, VIX, a volatility index. But let's go to the numbers. Dow was down 154, 12,486. S&P's down 21, it's 1313. Comp index down 52 at 2839. Apple's leading the way down. And we've got the cyclical index down 22 at 874. The New York Stock Exchange is down 132 at 7486. Now, the Russell 2000, let me just quickly put this up here, IWM. The Russell 2000 is down 128 at 7621. Now, what's very important about a number of these charts is that they were trying to rally back, these indexes, key indexes, rallying back to a new recovery high and failed underneath that. So far, most of them are failing at a peak C in the ChapmanWave. If this decline accelerates further instead of finding support, this is on all the indices, that would be very negative, because a failure at the third highest peak, second or third highest peak, without even getting to a peak D, shows internal weakness. So yes, we've got healthcare, the decision's going to be coming down either today or tomorrow. We've got a number of things, but I'm just looking at price point. The price point is the arbiter of a trend. And so we were looking at higher highs and higher lows. All of a sudden, there's a chance we could start to make lower highs and lower lows. You've got gold down. It was down, now it's up. It's up 680 at 1573. Silver is up 10 cents at 2677. Bonds are up $1 and 6/30 seconds. Technically, I would say that between Friday and today, I would have expected bonds to be higher. The TLT, which is the Lehman 20-year T-bond fund, and for the folks who did my all-day webinar just a couple of Fridays ago, I sent them a questionnaire on the ChapmanWave, what they're thinking of the TLT. But basically what we're looking at here, just on the shorter term, is that there is the potential for a cup formation, number one, and the reason being that, let me expand this. If you're looking at Tiger 1, usually my left side chart is the daily chart, the middle one is the weekly, and the far right one is the monthly. I'm expanding this now so that you can see it much clearer. In this particular chart, what you've got is a pattern that I call, yeah, let me just move that away. I just want you to be able to see it, so I'll move. I'm not going to eliminate the notation. I'm just going to move it to the side. In this particular pattern, what you're looking at here is that from the high of 130.38 on the 1st of June, the TLT, Lehman 20-year Treasury T-bond fund, came down to 124.39 for trough A. Remember, on the way down, we look at troughs. Bounced to a peak A, failed at that peak A, which became an A minus, because the price went below 124.39, so it went to 124.38. That 1 penny in my work is the difference between not making a peak or a trough or making it. So it's very important. That's your only obligation in this particular technique of the ChapmanWave, is to be very careful not to miss a peak or a trough. It rallies again, goes to another high, a recovery high, 127.34 on the 18th of June, and then pulls back and makes a lower low at 124.09. So that's trough C. So you've got trough A, trough B, trough C. But this is a pattern in my ChapmanWave CD called Introducing the ChapmanWave Methodology. I talk about the lowercase h, this pattern that I call the dreaded H. And remember, it came about as a dreaded H because there was a period where many people were very bullish. And I said, yep, you can be bullish, but if you close below the left side low bar in this pattern that looks very much like an H, let me just draw it here for you there. There's the down move. It doesn't always have to be straight. It could be diagonal, but it's a down move. And then you have a little rally. And then the price comes back and it makes exactly like an H. Comes back. I should make this purple so that you can see that's the H there. There you go. There are three rules with it, and each one has a different implication for a bounce. And this particular instance, it went below 124.39 but closed above it. That says you can rally, but you're probably going to stop somewhere around the previous arch high and then come back and have to do a retest. Unless the technicals turn around, the MACD and stochastic turn around and give you a buy signal, which is something very important. So now look what happens. The MACD, the moving average convergence divergence, see that red line is the slow moving average. The yellow line is the faster moving average, means that the look back period is quicker. And it makes a deflection lower, and it still has not crossed positive, although it is flattening out a little bit. But so far it's negative. And these vertical, these green and red vertical lines are volume lines. So that's not what you're looking at. But if you look at the gray lines within it, and yep, you can just barely see. You can see it. Let me turn this the other way around so that I can see what you're seeing. Yep, you can see those gray lines. Those gray lines are still under the 0% line, that 0% line, and it's at minus 0.29. So it's still negative in the histogram. Histogram is the makeup of the 26 divided by the 12. And that's also the 9-period exponential moving average. Now look at this. You've got the stochastic trying to turn up, and then suddenly it succeeds in turning up, and it goes from under 20% to 35%. So that says that the H became an M pattern. See right there? And that can go on for 2, 3, could even be more. But then usually the shape, the actual arch formation increases. It says that the third time is where you've got to be careful, because if the technicals start to improve, it could rally, and these three bottoms could turn out to be very powerful, especially if it takes out the left side high bar, which is 127.34. So I'm very clear on what I'm looking at here. If there's a failure, news comes out later today or tomorrow, whatever it is, I'm waving my hands, and it's perceived positively by the stock market, and bonds start to fall. If bonds break under 126, the 9-period moving average is at 126.10. You see all the techniques we're putting together here? It says, aha, yet another retest of the 124s is likely. But if within the next 2 to 3 days there's a decisive close above 127.34, the power of the upside says that the cup formation could very well take the price back to the next left side most important candle. And that candle is not this one here, but it's the doji candle of the 4th of June between 130.18 and 128.94. So close above 127.34 sets up a chance, leg B probably, to go to that doji candle in the 128s. So that's the way I'm looking at it. That's a market. It's a market analysis. It's a bond analysis based on the TLT, which is a 20-year, and bonds are the 30-year, but the chart patterns are very similar. Look at this, USU 12. See, it's the same sort of thing. You've got an arch formation. In this case, it's just an H formation. And this particular bar right here is still just okay. It's not great. It feels like it's great, but it's really not. It needs to decisively, bonds at 149 and 9/30 seconds. Bonds need to take out 149 and 22 30 seconds. Funny they still trade in 30 seconds after all these years. I remember when we changed from 30 seconds in the stock market, eighths. Anyway, that's what happens when time flies. So we're looking at, and then bonds on a much longer term. You remember my expression, the Japanization of bond yields? Very interesting, because that channel that I've talked about, spoken about for, just forever, the price, even with all this, is still above the up channel breakout line, which is around about 145 and 230 seconds, somewhere around there. And this is a continuous contract, so every once in a while I have to change the lines because the price gets smoothed out. But the highs and the lows are exactly right on dates. The price varies slightly. So, okay. So now what we're looking at is the bonds, and to put that together, I'm going to say VIX, Volatility Index. The VIX index right now is at 20.83. Remember, I've made it real simple. Under the 20s, and you'll get buying pressure. Holding under the 20s. In the 20s, you get selling pressure. The candle that was formed last week was very ugly at the end on Friday. It said, whoa, what's going on? You could break that wick very easily at 1677. But that's got nothing to do with the following week. One bar at a time. That's all you can do. And that bar says that if this week the volatility index breaks above 2174, which is the 200-period exponential moving average, we've got to anticipate that the weekly chart has a chance to get to 2355, and all that's going to save it is for a repellent from this area back into the under 20 for the market to start to find its feet on the upside again. I'm just trying to make this as clear as I can. It's just you just couldn't be clearer than that. Volatility above 22, this market goes down. The Dow goes down to the 12,200s or lower. The S&P touches 1290s. The volatility index slams down. For what I don't care what the reason is, slams down. That's the reason why for quite some time I have been looking at markets. I'm not really wanting to trade the indices, although it would have been great on Friday to have picked up the SDS, which I showed in my opening course, my daily service, as a possibility. But when things move overnight so quickly, it's a bit risky to grab it at the opening when we are when I haven't yet got the clarity of having a couple of more sessions with the volatility index above 20 or below 20. So that's that. Now let me just go through this. The dollar index broke out of that downtrend line. Remember we were talking about this? It made a peak E-top in the ChapmanWave from the low that was established at 78.60 back on the 78.60. That was on the 1st of May. Funny, 1st of May, 1st of June. And then it runs up peak A, B, C. Look how simple this technique is. D goes to E on June the 1st. It's 83.54. Pulls back, but no, it takes a longer period to pull back, doesn't take out the most important left side low bar of 80.90 from the 21st of May. Instead, it's been climbing up and is now nicely above the 9-period moving average of 82.13 support. And it's trying to test the bar of 82.73 of the 12th of June. Today's high is 82.63. I think I've covered a chunk of things. I'd like to look at the euro-dollar currency pair, and I'd like to look at crude oil, and then a couple of stocks that I'm going to do. And while I'm at the break, something in the den about feeder cattle. Let's have a look at feeder cattle. I have no idea which there it is. Okay. All right, I'll be back. Hey, Basil Chapman, 877.
You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor, Foreside Fund Services, LLC. With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you gain access to each host charts and computer screen as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, Kate Stalter, Dave White, Larry Pesavento, or Victor Jones, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV yet, then visit TFNN.com today to see what you're missing.
Stock market corrections are the number one reason that a buy and hold investment strategy produces the poorest results, and I have 73 years of data that proves it. Now, the good thing about economic difficult times is that the worst economy can produce the best rewards in the shortest period of time. In fact, during the last 130 years, 61% of that time period has been spent in recession. And if you're one of the 70% of American households relying on their 401ks and IRAs for retirement, you need the single strategy that is bulletproof against the turmoil of our stock markets. Go to the homepage at TFNN.com. Under Breaking News, click on Success is a Numbers Game to receive this must-have free report. This bulletproof strategy may be days away from giving the next signal. Don't neglect your retirement, and don't neglect this signal. If you're even a little bit interested in accumulating wealth, providing a better life for you and your family, then go to TFNN.com to order your free copy of Success is a Numbers Game today. Implement the disciplines contained in this report, and success will be yours for the taking.
Kate Stalter's exciting newsletter, Low Priced Leaders, has just launched, and now is a great time to get a 2-week free trial. Every Wednesday afternoon, Kate sends out her weekly newsletter to her subscribers where she focuses on small cap stocks with market caps under $2 billion, as well as low-priced equities with share prices ranging from $5 to $12. Kate tracks a variety of stocks with a combination of strong technical support and solid fundamentals. Many of the stocks featured will be recent IPOs. These newer issues are often some of the biggest price gainers in the market and provide an excellent opportunity for substantial gains if timed correctly. You can catch Kate Stalter live on Tiger TV with her small cap roundup every Tuesday and Thursday at 11 a.m. Eastern Time, and visit TFNN.com right now to get your 2-week free trial to her brand new newsletter, Low Priced Leaders, while locking in the low introductory monthly rate of only $37.50 per month, almost a 50% discount. Act now. It's that time of year again, and the Great Panther Silver Summer Silver giveaway is back. Every day in June, Monday through Friday, we'll be giving away a Great Panther Silver 1-ounce silver bar, and all you have to do to enter is visit the front page of TFNN.com and fill out your entry. Great Panther Silver and TFNN wishing you a great start to the summer. Sign up today to have a chance to win a 1-ounce silver bar during the Great Panther Silver Summer Silver giveaway the whole month of June at TFNN.com.
This segment is brought to you by BackTech Environmental. For more information, just click the BackTech banner on the front page of TFNN.com.
Hi everyone, Basil Chapman. So I want you to look at the euro. I did mention feeder cattle. Feeder cattle looks like it's coming down, and if it closes under one, my continuous contract says that if it goes under two things, 149.52, the low of the week of the 6th of April. 149.39 is the 200-period exponential moving average weekly support, but the way the MACD's deflected lower and the way that the stochastic failed to even get to even 60%, and it's now at 43% in the weekly chart, and my monthly chart says there's a chance that it's turning down after a peak F top, almost like a triple top from going all the way back to, it's quadruple top from December of 2005. This is not pretty. So on a monthly basis, unless a feeder cattle can get back to the 160 area plus, closes under 150 points. So if it closes under, 148, good chance it's going to try for the 143 to 140 area. Wow. Feeder cattle, huh? That's interesting. So, okay. The euro, EUR-USD, and at 877-927-6648. Love to take your calls. And euro is breaking down. I was talking with Peter from Park City on Friday about the C1, C2 double top. In the ChapmanWave, a technique that I developed is a variation of a technique, waiting for peak D to occur. And I discussed it in detail. Now, what we've got here are two patterns, they're conflicting patterns. One is already broken, so it says, whoa, be careful. And that is an up channel It could be an inverted ChapmanWave falling axe formation, but I'm calling it a channel just for now, for clarity's sake. That up channel should have remained, and the price should have gone to that leg D up. And this is the euro, which is trading at 1.248, down 0.007. Now, what's very important about this is the MACD is still holding well, but the stochastic is decisively negative. And that says, it's a big conflict when this happens occasionally. In April a year ago, we saw this. The MACD. And I was saying, until certain levels are pierced, you've got to consider that MACD is showing strength, but the histogram is sliding quite sharply. So it's a conflict there as well. I'm going to go with the price movement. I'm saying, as it stands right now, because of the weekly chart formation, which is still negative, that the euro, if the euro closes under 1.24, and right now it's at 1.244, it's at 248, on Friday at 4 o'clock, that's going to be negative. That's going to say that there's a good chance you're going to test the lows, the most recent low of 1.228. Wow. That's also not very good for our market, I believe. So this pattern, this conflicting pattern says that if, I'll do it right here, I'm using that bar, there's always a particular candle that I use for my midpoint. So I'm calling that green. Just follow me. Here we go, green. Now I'm putting in the red side of it. You're looking on Tiger 1. There's the red. That says this would be the target if the MACD crosses negative, and that would give us a target of the 29th of June as a potential to touch the area of 1.29 to 1.228. 1.229 to 1.228. I did change that, right? Yes. So, okay. So I wanted to get that done. What's going to improve the euro? Only if the euro goes above 1.257, the 9-period exponential moving average. So we've got that. I've got everything in the den. IDIX is a question. I'll take questions in the den if you want. Oh, man, IDENIX. Why haven't I updated it? Oh, okay. It's done. So let me just do this. A, B, C, and that's trough A and trough B. Now, when those prices come down, and it's only a trough A and a B, and then it starts up again, I usually consider that to be positive. That's why I do the troughs on the downside. Even though it's the trough on the upside, D, E, and F, that are absolutely imperative to monitor. On the downside, it's the way the technicals and the chart patterns occur. For some, you would expect that you could, maybe I'll find it in 6 months or so, because I'm always investigating. But the more I work at this, the more I say that my price, the troughs on the downside for my work are not quite as that. They're important. They're not quite as important as the way the chart patterns unfold. I'm not sure why that is, because so much I see a concurrence in so much that I do with the downside to the upside action, but that's all I can tell you. So we're looking at IDEX, IDIX. It's IDEX Pharmaceuticals. It's made in A. Oops, I hear the music. Wow, that was quick. C. This is making a D in the daily. All right, I'll do this. This is a beautiful looking chart. I'm going to do this when we get back. I mean, the daily is the week. The monthly I have to do a little more work on, as well as the week. I'll be right back straight after this, and then we'll get to Fred in Denver as well.
If you're an investor looking for a great weekly investment newsletter, then now is the perfect time to try out Ken Shreve's Ultimate Growth Stocks. Every Tuesday, Ken breaks down multiple sectors in his weekly newsletter, Ultimate Growth Stocks, with a full in-depth report including specific trading recommendations within his model portfolio, charts, sector analysis, upcoming economic data, along with intra-week trading updates on newsletter positions whenever the market dictates. Right now, you can receive a full month, that's 30 days, to evaluate Ken's newsletter free of charge to see if it fits your trading plan. At less than $75 per month, Ken provides you with his expert trading advice that can pay for itself in no time. Take advantage of this great offer by signing up for a 30-day free trial to Ken Shreve's Ultimate Growth Stocks today. Don't let this offer pass you by. Visit the front page of TFNN.com and sign up now. Would you like a personal update from Tom O'Brien as to what equities he's trading and what his daily trading plan is before the market opens each morning? Every market day, Tom O'Brien sends out his daily newsletter, Market Insights, to hundreds of subscribers that rely on his daily recommendations when it comes to navigating these highly volatile markets we're dealing with. As recently as May 21st, Market Insights subscribers closed out all 5 open positions for a combined profit of over 68% in one day. Profits ranged from 6.5% to over 24%, and all of these trades had been initiated within the previous 30 days. Now is the perfect time to get a 2-week free trial to Tom O'Brien's explosive trading newsletter, Market Insights, an $85 value. Tom breaks down the market each morning with his market take and provides trade recommendations including precise stops and target profit zones, leaving nothing left to guessing. Log on to TFNN.com today and sign up for your 2-week free trial. Make sure you're a subscriber the next time Market Insights subscribers close out multiple winning trades. Take action and sign up for your free trial today. Has the current market volatility continued to stop you out of trades when temporary market spikes move against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped, and you have the advantage of keeping your trades open even when the market temporarily spikes against you. Nadex's innovation has allowed them to come up with a line of unique short-term binary options that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. TFNN has just launched our most exciting sale ever. If you purchase any amount of Tiger Dollars before Sunday, June 24th, you'll receive access to 7 live 90-minute webinars hosted by each of our technicians here at TFNN. Not only do you get a 20 to 30% bonus on your purchase as you normally do with Tiger Dollars, but with this one-of-a-kind offer, you get over $1,000 in added value completely free. Each 90-minute live webinar usually sells for $149, and you get all 7 of them absolutely free. Tom O'Brien, Steve Rhodes, Basil Chapman, Larry Pesavento, Ken Shreve, Dave White, and Kate Stalter. You get all 7 classes completely free. Whether you're an experienced trader or you're completely new to the markets, this sale is perfect for all levels of investors. Don't miss out on our best Tiger Dollar sale ever. Visit the front page of TFNN.com today and purchase your Tiger Dollars before June 24th. Don't wait and risk missing out on this one-of-a-kind offer. Act now.
This segment is brought to you by Harmony Gold. For more information, just click the Harmony Gold banner on the front page of TFNN.com.
Hi folks, Basil Chapman, and we're going to go right back here just quickly to finish up the IDEX side. The question was, I'm not sure if you are long or not, Ivan, but you know, as far as I can see, there's a pattern that I took. I love this pattern. I haven't actually spoken about it. Oops, Ivan, I just did the chart of Ivan. It's IDEX, Idenix, I think it's called. Oh boy, IDIX. There it is. Idenix Pharmaceuticals had a high recently of $14 and $15.25 January the 12th, January of this year, pulled back to $7.17, and it's had a nice run up, and then it went. This has to be news. See, I get a little concerned with biotechs because it's really hard. You've got to discern. There's a cyclicality. Whenever I talk about biotechs, I talk about the U-shaped patterns or the arch-shaped patterns, because news is generated either quarter by quarter or earnings per earnings, and those are very deceptive. And if you're on your way up, you've got to be very careful, because that could be the cyclical high, and then it starts down to make that U pattern, which is done so often using the 200-period exponential moving average. There you go. Positive news on recent trials. But the fact that it's holding so well in this rectangle formation, Ivan, I'm going to ask you, are you long? Because if you're long, it's a completely different thing to if you ask me what to do right now. If you are long, then I would say that some part of your position, if it takes out $10.11, that's the spike high of the 20th, that's the rectangle formation that you got to watch carefully, because if it slips just a little bit lower, that's fine, even up to $9.89. But if it goes lower, then $9.82, the high of the 18th, the day, 2 days before the spike, all of a sudden you've lost the momentum. This particular pattern says that if it can hold, and if there's any sense of strength, especially today when it's only down 26 cents after such a spectacular move at $10.56, you've got to watch this because it has a chance to try to make a new recovery high, and then you've got to be careful. So if you are long, and it's based on news, because of the news has held up for 3 days, I'm impressed for the first time in this chart for quite a while, number one. Number two, because it's a biotech, I know that you know, and that you've bought it already, you've probably bought biotechs before, they can be hazardous to your health and your wealth, even though they have great health benefits in the end. And the reason being is, look how quickly they slide, but look how quickly this one can also run up. So my recommendation is try to keep a core position. But if it closes, if you've already long, if it closes under that $9.80, start thinking about maybe lightening up a little bit, because this is news related. You might have to wait a full cycle of maybe 2.5 months before it has the next big run up. So I like the action very much. I did a 120-minute chart on it. It's the same thing. I teach this particular pattern when I do my Master Trader series because it's a very significant pattern, because it can hold, as long as the price holds up for a certain amount of time. You remember Apple did that? It can keep trying to retest the highs and then make a new high. But I would lighten up. If it goes above $11.05, I would say, okay, time to take a little bit off or raise the stop to about $10.92 or even a little bit higher if you do that on some part of your position. But as a chart formation, the monthly has made a peak E, the MACD is holding well, the stochastic's pulling back. So the fact that it's moving against the stock market trend right now in the monthly says it is trying to touch the $11.52 200-period exponential moving average. First of all, congratulations on having a stock that is going against the general grain of the market. And secondly, I would treat it as 3 positions, maybe your core positions lower down where you bought it. And then what I would do is I would take something off because of its history of pulling back at certain points. And the one would be sliding below, what did I say? I think I said $9.92 or $9.82, whatever it was that I said. No, I'll tell you right now. It goes underneath, so 10.11. 9.82. Yes, if it goes under 9.82, be real careful because it could pull all the way back to $9.06 if the general market keeps going down and this thing has had its news-related event. So those are the parameters. If you can keep a core position and you're able to hold on, I suspect the way it's acting right now that there will be further upside action. Let's go to our first caller. We've got Fred in Denver. Hi, Fred. How are you?
Hi, Basil. How are you today?
Very well, thank you.
Yeah, listen, I want to check what a good entry point to TZA would be. It gapped up this morning. I didn't expect it to gap up that fast this morning. Didn't buy a position, but just wondering when I might expect to pull back to get into a position which is a short.
Now, the other aspect that you're talking about is that when it moves so quickly and the pullbacks are very slight, and it keeps making new recovery highs. Folks, we're looking at TZA, which is 3 times the short position. Now, isn't the short position of the IWM or the IW? It is the IWM?
Short position of the Russell 2000.
It is the 2000. Okay, because I checked out the other, Russell 1000, Russell 3000. They're slightly different chart patterns. I'm going to make a recommendation, and that recommendation is you nibble on the TZA right here, even though it's not the best position. But the reason why I say nibble is whatever your original position was going to be, you can't. It's too late. Just in terms of risk reward. In fact, you could go 300% along the 300 right now, and it could turn out to be the most fantastic position. But the risk reward, just in money management, says that's really not what you want to do, because even though the chart on the TZA is actually looking quite good, it's just not what you want to do with a 300%. So I'm going to say start a position right here, and this is what I'd be looking for. I'm in leg C. The TZA is in leg C in the 120-minute chart. It's had a history of making Ds and then pulling back. So that's a good sign, number one. Number two, the daily chart is in leg B, and it's gone above the high of 21.18 on the 18th of June, and it's at 21.22. It's gone to 21.25 already today.
Yeah.
There is news that's coming out, and that news, for all we know, could affect the market either way. But the action that I'm looking at right now, based on the VIX, based on the dollar, based on my three bears, that's VIXy, Dolly, and Bondi, says to me that the TZA, based on the way the IWM is pulling back sharply from a peak C and underneath the 200-period moving average, and I'd drawn this pattern, discussed it on Friday, the arch formation. The arch formation says that from the pattern we're looking at right now, if the IWM takes out 74.78, it's at 76.06. It's not there yet, but if it gets there, 74.78, that's about a point and about a point and a quarter lower. There's a real good chance that this thing's going to keep coming down, and my target would be the low of 68.91. That's only if those conditions are met by the 3rd of, on the weekly, by the 3rd of August. So that's saying there could be time and price involved, but only if it takes out, and that, by that I mean closes on a Friday at 4 o'clock below 74.78. If it does that, then all of a sudden the MACD and stochastic will really be very weak, and the deflection of the moving average in the MACD and the stochastic in the monthly chart says that's negative action. What we did on Friday, closing underneath the 9-period moving average in the monthly chart of the IWM, was not good. It meant, well, we're just over 2 hours into this week, so I can't talk about this week as if it's closed. But if on Friday the IWM is not closed above the 9-period moving average, or very close to the 77.83 area, but instead, or maybe 73.80 or higher, but instead is anywhere around here or lower, that's just going to be very negative. So my bias right now is to say everything is pointing to the IWM failing at peak C and going to a peak C minus. The MACD is still not in the daily, not yet crossed negative. Stochastic is negative. So on a small position, TZA right here, small position, what you want to see is that you can use, it's a little, for a 300%er, it's at 21.18. The low is 20.72. That's about 40 cents. That's a big percentage for a stock like this, right?
Yes.
So I'm going to say to you, a small position, if it takes out by 3:15 this afternoon, if there's a reversal and the TZA goes under 21.02, let's be safe, let's say under 21, I would start to tighten up my stop on this. The reason being, there could be a turnaround by late day today into tomorrow morning. If, in fact, it takes out today's high of 21.25 at 12 Eastern Time, at 12:35 to 1:15 today, if it's making new recovery highs, you can add another small position to your entrance, and that has to have a much tighter stop. So I hope that helps you. So you're starting with small positions, and you will see by Monday. You'll see by Wednesday afternoon whether or not this has the potential to go to the high of 22.27, which is the high of the 14th of June. If it starts to get into that area, this market is going a lot deeper to the downside. So I agree. The MACD hasn't turned positive yet in the daily. It needs to cross positive, but the stochastic's now gone above 20%. So I have 3 out of my 4 rules for a buy signal going to a buy mode. I need the MACD to cross positive, the fast-moving average. If you're looking at Tiger TV, I need for the fast-moving average, the yellow line, to cross the red line, and then I've got a buy mode which says this thing could even go to a leg D. So I hope that helps you.
Basil, you've been a godsend today. Thank you so much.
Thank you very much, and I appreciate you calling, Fred. Fred in Denver.
Go for tennis, buddy. Okay.
I'd love to, but it's raining outside, and maybe this afternoon's tennis will be canceled, but I've got it planned. We'll see what happens. Thank you for calling, Fred.
Okay, bye.
Thank you. Now, let's do this, folks. There are a couple of things I wanted to do. I spent a lot of time this weekend going through the IBD list, a whole bunch of things in the IBD, Investors Business Daily. Now, I wish there was a format for me. I just really don't have time for it. I'm sure there is a format to be able to show you the ChapmanWave as it goes through these different iterations. Q-Core, which is the number one stock on the IBD 50 list, has extended to leg F/B. I'm not going to go into the ChapmanWave right now. I'm just giving you the letters. That's a new recovery high in the weekly, but it's a new all-time high. And it's one of the reasons why you want to keep your eye on some of these Investor Business Daily stocks, because a lot of fund managers just use this. They kind of get the cues for the stocks that they're looking at based on the analysis, the very detailed analysis that's done in something like an Investor's Business Daily. And I like to use it as well. So this is still acting beautiful. Can you imagine up 56 cents, up 1% when the general market is down 1.3 and 1.7, 1.3 in the down, 1.8 on the S&P. So relativity is really important, regardless of what Einstein said. Now what we've got is leg D up in the SXCI. And that made a 103.97 high on the 19th of June. And it's pulling back now, and it made a peak F in the weekly. So this is, here's a stock that could turn out to be vulnerable. If it has a high level consolidation, that's one thing, but it actually did make the peak. Is something going on here? I know I did these over the weekend. Why is it not showing peak D? Okay, this is leg D in the monthly chart. MACD is still screaming up, and the stochastic is still very strong. But the weekly chart says, be careful, because I'm showing relative weakness in the verticality. Let me show you what I mean by that. When you go to the high, it was made in SXCI's SXC Health Solutions Core. It's trading at 92.81, down 270. On the week of the 20th of April, it went to 100.50. When it went to peak F last week, I'm calling it peak F right now because everything else points to peak F, went to 103.97. The stochastic was way lower, under 80%, and the MACD was turning down. So that leaves the monthly still very strong, and tremendous support on a worst-case basis of 76.37 at this particular point. But if this peak on Friday, if it closes under the weekly 9 EMA of 91.18, that's going to be a big negative. Now, I had a question in the Den, Merck, MRK. Merck, of course, one of the great pharmaceutical companies, Merck and Company. Also, you see, now this is a defensive stock. Now, what's the difference between a defensive stock and a stock in the defense area? Well, a defensive stock is usually a stock that acts pretty well when the general market, and especially the cyclicals, are declining. So Merck made a high, was that an all-time high? Let me just open up this chart. No, an all-time high was 91.50 back in November of 2000. It came all the way down to 20.05. The most recent high was 61.82. This is a peak G Doji high in December of 2007. So now what it's doing is trying to work its way around the 200-period moving average. I'll discuss this a little bit in more detail when we get back with these very important messages. Hey, folks, I see that the special's on. They haven't taken it off. The special is on. Go to the front page of TFNN for those 7 fantastic webinars, and you get a huge discount for that.
Put the power of the ChapmanWave methodology to work for you. No matter what market you trade, what time frame you trade in, or your trading style, the opening call, Basil Chapman's daily market newsletter, is bursting with the information and trades you need to become a more successful trader.
I've been using Basil Chapman's ChapmanWave methodology for several years now. His ChapmanWave can be used for any time period for not only equities, but futures, currencies, commodities. I've been also a subscriber of his opening call, which I find an invaluable tool to help me analyze the potential of the market each day. He gives you opportunities to go short and long. It includes recommendations on stocks. I strongly recommend people using the ChapmanWave and very, very strongly support the use of his opening call.
To find out more about Basil Chapman and his ChapmanWave methodology, and to get your 2-week free trial of the opening call, a $64 value, visit tfnn.com today.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the Rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to tfnn.com today. Don't miss out on this great offer. Act now. David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to tfnn.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today. Great Basin Gold is a mining company engaged in the exploration and development of 2 emerging gold properties in Nevada and South Africa with a total resource base of more than 23 million gold ounces. Great Basin's Burnstone mine in South Africa opened in February of this year with a resource of 20 million gold ounces, becoming the first mine to open in the historic Witwatersrand Basin in the last 30 years. The Burnstone mine is projected to have a 25-year mine life and is fully financed with production anticipated to be over 250,000 ounces per year at a cash cost of only $450 per ounce. The Hollister mine in Nevada became fully integrated in the 4th quarter of 2010 with annual production estimates of 110,000 ounces of gold per year over the 8-year mine life at a cash cost of only $527 per ounce. Great Basin Gold is cash flow positive and trades on the Toronto and New York stock exchanges under the symbol GBG.
This segment is brought to you by TFNN. Test drive all the newsletters for free at tfnn.com.
Hi everyone, Basil Chapman, and we are looking at a situation here where Merck is showing good relative strength. On a daily basis, the MACD is still expanding. The stochastic's at 89.63. It's at 39.75, down 44 cents, down 1.10%, a little less than the market. But what's most important is that the monthly chart has tried to use the 200-period exponential moving average as support. It has bounced off the 9-period moving average. There's a chance that the cup formation can make what we call, or what I call, a cup and ladle formation. That's a ChapmanWave technique. It breaks out above the left side lip, that's 39.50 from the 1st of May. Oh, 1st of May. Remember, we're looking at stocks making lows on the 1st of May and then a high on the 1st of June. This one made a high, so you can see as a defensive stock what it's done. It made a high on the 1st of May and a low at 37.02 on the 1st of May. So this is going to be important. Why? Because this is either an instant restart. Don't want to make it too complicated. But ChapmanWave instant restart, and it's either leg B, maybe peak B today, or an F. If it's F, then what you want to see, if you consider it an F, peak F, then you're going to see a sharp pullback, and it should take out the low of Friday, 39.55, within 2 sessions. and then try to test the most important technical indicator. In this case, I'm going to treat the 39.27, 39.29 9-period exponential moving average as key. If it doesn't take that out in the next 2 days, in fact, it doesn't even take out the low bar of 39.55 of Friday, but instead it closes, anywhere at 39.80, anywhere in the 40.01 plus area today, it's going to say to me, hey, that weekly chart you've notated, that is leg C. And that says it should go higher. There's two patterns that are unfolding right now in the weekly pattern, and that says that it could be making a cup and breakout pattern. That's this one right here. There as well, doing it the monthly, and it's doing it in the daily. It's done it in the daily, now it's doing it in the weekly. That's very positive, and it says that if this is the pattern, the cup and ladle breakout, it should go to at least a D. That would target somewhere around 41.30s or even a little bit higher. So far, Merck is a good counter-trend stock to be talking about with a dividend and a safety factor. Of course, the safety factor only means it has to hold the support. If it closes under 38.29 in the next 39.29 is the key, but if it closes under 38.29 by Friday afternoon, safety is not a factor here. Just protection of your capital is your focus. Now let's just see. That's it. Okay. ALXN. This is number 3 on the list of Investors Business Daily. Made a peak D top. MACD still holding well. Stochastic's turning down, and there's that cup with a potential for a cup and ladle, but it hasn't decisively gone into the bar. It has to go into the wick of last week. So in other words, if ALX on Alexion Pharmaceuticals, for me, all these pharmaceuticals are the ones we're talking about here. If it gets to 97.22 at any point this week, not only will it retest the high of last week, which is its all-time high of 99.41, over the next week or so, it should go even higher. I'm a little concerned about this. The reason being, the monthly, I'm not concerned anymore because I've just seen that the monthly is recycled to G/E. So the MACD and stochastic still very strong. So you can see when you pick up your stocks, if you check out the IBD, you'll be able to check out stocks that have. Now, this is not a plug for IBD, although I know the paper from 1980s, 1985 or something. I think it's one of the most fabulous papers, but it means it's done the homework for you, so you can look at the stock, and it's done fundamentals as well as their own technicals. Then you can add your own technicals. I just want to mention that because these have been the leading stocks on the way up. We're going to watch them carefully here. We are long and we are short. We have long stocks that seem to be holding well, and we have short stocks that are also going down. That's what we want. Thanks for being a stay tuned for Larry.
Are you looking for a